Markets around the world are crashing. With Trump tariffs and the announcement of a crypto reserve, we've just witnessed some of the wildest swings we've ever had, with over $1 billion in liquidations in just the last 24 hours alone. So what exactly is going on? What should investors and traders like you and I do in these types of times? Well, in today's video, we'll talk about the dark pool liquidity from Wall Street, the biggest options flow, and of course, the number one thing that we should be watching at this stage. It's getting close, and we need to talk about it right now. Join us as we cover stocks, commodities, and cryptos in the days ahead after all of this news. We've got to cut through it, and we'll do it right now. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. As we've suspected all year, it's been defensive, and healthcare continues to be one of the best sectors of the market. But the problem lies in semiconductors and generally growth. We're seeing huge sell-offs across the board, and of course, Wall Street doing a couple of interesting things. So let's take a look at what the market actually is doing and why we need to be paying attention to structure in particular over the next coming months. Are we heading for a US recession? Well, first up, it really comes down to how have we been doing over the last 12 months? And as you guys know, generally markets will actually show us a certain level of structure before peaking off. Now, at the moment, we've been up, down, and all around for around 2 months. And this becomes an important factor because we basically find ourselves at what's called an inflection point. After the rate cuts of last year, markets will usually go in certain trajectories. And so far, it's been a non-recessionary trajectory. We usually last for around 6 months on that, and then we find ourselves in a place that basically could either lead for a recession, moderate growth, or extreme growth. My guess is probably moderate growth at this point, but we need to look at the structure. Remember, we always say, let's not actually predict, let's look at the data and look at what the market is telling us to do before we go and make crazy decisions either way. Now, one of the big decisions in the markets right now has been from Warren Buffett, building a cash pile recently of over 25% in the market. What is he seeing? Is he just not prepared to go into this type of volatile time? Or does he just think that everything is overvalued? Well, we recently polled you guys, and most of you thought the market was overvalued across the board. And of course, that seems to be what he's doing. Many people have different arguments, but I've long argued he will follow his path all the way into the hundreds and whatever age he ends up getting to. I very much doubt he's going to trade or change his style just because of tax or other things that people are saying. So what about this week ahead? Well, we have two big things. The US jobs report and of course now the announcement of the crypto reserve, however that will look and shape. So of course it comes back to really saying, well, will the Federal Reserve bail out the market once again in the face of all of these tariffs? And of course, how will the tariffs actually be implemented, and will they last even more than a few days or weeks? Well, of course, this will be the discussion, and we have two options, the Trump put or the Federal Reserve put. And as we know, the Federal Reserve could be accommodative and start talking about rate cuts again just as early as this week, with Fed Chair Powell speaking on Friday after the non-farm payrolls to pretty much discuss what is going on with the US economy. The Fed certainly could be accommodative, and of course that needs to be taken into account. But I also want to talk with you guys about this, the latest bull market bellwether signals. 7 of 8 bellwether signals are signaling a top in these markets, and that has not been a good sign generally in the past. As we mentioned, financials are actually following an incredibly bullish path at this stage, and that's pretty important because, of course, if financials continue to drive higher, that usually has meant that we're not in a financial crisis, and whatever pullbacks happen tend to be bought up. But if you have a look at some of these other things here, the Dow Jones Composite, Transportation Average, Utility Average, the Russell 2000, and many other sectors of the markets, we've been unable to achieve the November highs that were back last year. So in 2025, even though markets have made new all-time highs, they haven't done it with every sector. They've mostly been doing it with financials and the promise of deregulation and the promise of course, tax cuts. And that becomes the biggest focus right now for the market. If we don't get a tax cut and we don't get some form of deregulation, markets are most likely going to have a hissy fit. And this could push us much, much lower very quickly and instigate either a Trump put, which is of course a policy reform thing, or some form of Federal Reserve instant type of kind of come out and say, oh, we're going to do cuts, we're going to do this, we're going to do that. QE basically will come through. So of course, will that mean that we can follow the standard cycle? The cycle of up, down, and all around throughout February into March, and then rally into April and then beyond? Well, if we follow what usually happens, this can be one of the paths. And of course, we've followed this so far this year. Bit of a rally up and then bit down. But I thought we'd look at this data from Subu Trade, which is really interesting, which basically shows what when we have these up, down, and all around markets, down 1.5%, up 1.5%, down 1.5% in just 3 days, can we glean any information from this? Well, as it turns out, we can, and we can actually look at it mostly as a positive in terms of, yes, it is incredibly shaky for markets, but what it probably does is it instigates vol, it instigates puts, and because we know puts are already reaching records, which we'll look at in just a moment, that this is possibly a basing structure for markets. In fact, most of the time, if you look at 1 month later from these particular results, 82% of the time the market is bullish. Now, this, of course, you have to take with a grain of salt. Ultimately, it's going to come back to price action and some of the key levels we'll talk about. But as you will be aware, Q puts are on the rise, and we're now reaching extreme levels here according to macro charts. So basically, everyone is buying puts. And that's lent to a couple of little reports here, one from, of course, Goldman Sachs, coming out here that says there could be a momentum squeeze over the next couple of days. So basically tomorrow, this is effectively today, and of course it didn't happen today, will be a painful short squeeze day as risk assets are likely to rally aggressively, not only on crypto news, which of course we know that actually rallied then dumped, but also that they see 4 positive weekends in the news. So we did see the dark pools on Friday, and we'll talk about those more because guess what? There's more of them coming through. And we know that Wall Street and the algos love to do a little bit of stealing. So that's why the next couple of days are going to be so important. So first up, let's look at the dark pools from Friday. Huge buys, well, we have to assume they're buys, all at the lows. The market rallied a little bit, and then of course it's sold off to make a new low. And you might say, well, that's really bad. But let's take a look here. The Qs, one of the largest trades we've seen in the last 2 years, coming in near the lows. And you can see here that we managed to sweep the lows, that is make a lower low. And at the same time, we're still very close to where Wall Street probably bought a position. Now, why is this important? Well, as we'll look at the S&P 500 in just a moment, you're going to see a key level that statistically always gets hit in, of course, a year which has preceded something we saw in 2024. But we also saw a monster trade, the biggest ever, on the short Bitcoin ETF as soon as the market opened. I mean, you want to talk about wild moves, you want to talk about absolute manipulation of the highest degree. Take a look at this one. Number one, largest trade that we've ever seen on the ProShares Ultra Short Bitcoin ETF, comes in right at the perfect time. And then, of course, what happens to Bitcoin? Bang, it absolutely gets crunched. Don't know who it was, but it's certainly quite big. So let's look at a couple of positives here. Tom Lee, obviously, running some nice stats on NVIDIA. Again, take it with a grain of salt, look for price action, and we must have large traders start to buy NVIDIA positions. I'll be looking over the next 2 to 3 days, so make sure to subscribe for this to see whether we have huge dark pools, sweeps, big position trades in general around the most traded price, because this NVIDIA level does matter. But do remember, post earnings, it's tended to actually go up post those periods of time. And you might say, well, this time's different. Let's see. Let's find this price action. Let's see what actually happens. So as we mentioned a little bit ago, pretty much around 2 to 3 weeks ago, probably 3 weeks ago now, we were talking about the idea that at some point in Q1, we need to hit the 200 DMA. At least that's on average. 3 of 5 last times that we've seen the 200-day moving average be hit have happened in Q1. And remember, it's happened 100% of the time since the 1990s. So for, I guess, bulls, you're actually not really that sad to see the 200-day moving average be hit, because it probably at some point it was going to happen anyway. if we're going to play the same stats since the 1990s. Now the question then, will it actually find a bounce? Are we actually going to continue this V-shaped style, slow melt up style recovery? Well, I think that there's a difference between 2024 and 2025. This market is relatively sick. So what that means is we've lost home builders. We're starting to lose, of course, the S&P versus things like treasuries. These types of times are telling us that markets are turning defensive. And as we've argued now for really 2 and a bit months, we've been looking at healthcare predominantly a lot more because suddenly it becomes one of the hottest sectors of the year. Remember, 2025 is not so much about the indices as it is about rotation. And Wall Street is already proving this by going to Europe, by going to other stock markets, including China that we've been looking at, by looking at gold and basically buying those instead of just the standard Mag 7 style stocks. Just have a look at this chart, XLP versus SPY. As we've mentioned before, we've got defensive moves on this market. If we take a look at the corporate insider buy sells on healthcare alone, there are plenty of purchases coming in for the healthcare market. So basically, this shows us that insiders are pretty bullish about their stocks. And that's the first time we've seen that in quite a while. The last times we saw it, you can see the returns and you can see they were pretty favorable. Let's now take a look at whether this rotation makes sense in the markets. The biggest problem for Bitcoin and for the crypto markets is probably the consumer discretionary and semiconductors market. Basically, these high gamma stocks are really getting sold off. And when that happens, you tend to see that correlation with the crypto market, particularly with Bitcoin. The thing with the stock market is you have a lot of options. So of course, if you look at the last 5 days, one of our favorites, healthcare, is up there. Funnily enough, financials are still up here, which has to be a play on corporate tax cuts and deregulation coming through. So obviously the market's still feeling that. If it doesn't feel that, it's going to be bad, guys. I think it's not going to be very good. And of course, we need to be monitoring that one. But you'll notice the last 24 hours, again, a market turning defensive, a market turning potentially late cycle. Let's now have a look at the S&P 500. And we've talked about this a few times. Is this a Wyckoff distribution? So a bear is going to be very bearish on this right now because you've got that BC, you've got the UT and the UTAD. And of course, if the market gives up even levels such as 58.50, that could push down into the 57s, and you lose 57 and you're talking about a very different market. You're basically losing your bullish structure. And that's why we've said like this gap level here, which is where we find ourselves at this time of recording, and this 5700 level are really the two main defensive zones. So we've already seen some buying here. We know that Wall Street, well, we assume it's buying, but we know that Wall Street is least active around this level, which is a good sign. When we have a look at the futures, you can see here, these options levels won't be updated today, but I'll update them in the next session, so don't worry, guys. But this level here, you'll notice, is hit, and this is a very important zone. So we made a lower low, but what we haven't done yet is hit the green line. Now, the green line is the 200-day moving average. As I mentioned in our weekend video, it was almost better that the market does what it's doing right now, sell off more, hit the 200-day, maybe even hit 5,700, and then find a V-shaped rally, or at least a rally for the bulls, than it is to not hit this level. Because we know at least the stats alone kind of point towards that happening. So is the 200-day sitting at a good level? Yes, because it's sitting right around where you would generally suspect the buyers to really be. So that's, of course, a very important zone. Now let's take a look at the option zones. Does it make sense to find buyers over the next 24 hours? Well, in general, 5,800 becomes the focus. That is the biggest right of puts. 5,900, 5,850 were the previous day. And you can see here, they remain pretty much supreme. 5,850 is now the put wall, and we are currently trading at around 50 points, around that level, and 50 points above 5,800. So it's very possible that we could still see a sell on the next session into a rally. That would be pretty good. That would probably be the best case scenario. But if we keep pushing down underneath these puts, you can already see the negative gamma effects. And the fact is that there is nothing until 57 on the higher time frame. So that's on the OPEX, like the main expiration of options for the month. So a lot of stuff going on here, and everything needs to be put on the table. We haven't seen bullish structure really buy through yet. We've just seen the dark pools, and we've seen what we would say the first signs of potential buyers are there. But a lot of it's going to come down to these tariffs and the news surrounding them. Let's have a look at Tesla. What's going on with Tesla? Well, 310 is the call level, so we didn't manage to reach that, and 280 has traditionally been where we're seeing the puts. But notice when you take out a week, that 250 is coming up. Now, that's very important when we look at the chart, so we'll do that in just a moment, and we'll check it out together. When you're looking at NVIDIA, really, it's still about 115, 120. So I'd like to see NVIDIA hold right here, right now. It has to find big trades, and it needs to hold these levels. Because when you think about it, this is the most important level on arguably one of the most important charts, which is NVIDIA. I mean, NVIDIA has been the poster child of the bull market, and obviously it could be the poster child of the bear market if that was going to come through. So NVIDIA holding around this 115, 120, I think is a very important zone, and we'll be watching closely for large trades coming through. So remember to subscribe, we'll check those ones out. What about the bonds market? Is the bonds market starting to freak out? Well, it's not the same as it was just a few weeks ago. We went from being a little bit calm to a little bit more freaked out. We're not in super freak out mode, but of course you could claim this is a double bottom. And if we get another day of extreme volatility, then all of a sudden the bonds market is saying, you know what, I'm not too happy about what's going on either right now. When we look over to the yields are dropping through. These are now turning kind of nasty. Obviously great for that treasuries trade we've been talking about. But when you take a look at 20 and 30 years, effectively they're all dropping across the board. And although we did, I guess you would say, predict this based on data and based on evidence, and of course TA, in general, it's showing us that the market is starting to get concerned about the future of the US. So, of course, that is a good sign for these treasury bonds, but maybe not such a great sign when you're looking at some of our lead indicators. And one of those is, of course, consumer discretionary versus staples, what we call the American consumer. As you can see here, guys, the American consumer, it's looking weak. People are getting uncertain. Clearly, the market is taking kind of that into consideration, and that's a big drop. So when this happens, you've got to be paying attention. This is showing you that you may want to have one foot out the door on the markets and that you need to be ultra cautious. All of 2025 so far, we've been talking about no leverage, that is reduce your risk exposure. And obviously, as of about 2-3 weeks ago, I've been talking in my private community, links in the description down below, fxevolution.com, about how personally, I'm not looking to invest anymore in 2025 until we see other signs. We're starting to get some of my lead indicators that show that the next 2 years doesn't look that great. And if you want to know more about those indicators, of course, yes, we do have them in a course. It's called our Advanced Masterclass over at our website. Let's now have a look at the US dollar. It's starting to weaken, pretty much in line with the way we've thought about it. You'd say tariffs should raise it up, but there's a lot of other stuff going on here. So of course, in general, if we lose 105.70, we'd have to expect the dollar to start to weaken off. And gold, of course, is benefiting from this, along with silver, which have jumped up. Silver not at the trade level yet. 32 plus is what we're looking for silver to activate more trades, but it's still looking a bit better. Now, what about the stock market? Well, as we mentioned, healthcare has been a bit of a winner. And this has been actually one of the better ones for this year. If you go back to the start of the year, which is basically down here, you'll notice that healthcare is actually up 9%. You might not think that's much, but not bad on a defensive sector. So healthcare, insiders are buying, currently still looks good in price action. Obviously getting a little exhausted on this run as people are starting to catch on to it. But again, still very defensive market. And the key here is to actually look at XLV versus the S&P. And what you'll notice when you put this in is that it is significantly outperforming the S&P, which it hasn't happened in a long time. Look how bad healthcare has been. There are times to own things and times not to, and most of the time healthcare sucks, but it seems to be pretty good in 2025. Let's have a look at Tesla, 280, of course, interesting support, but as we mentioned, 250, are we going here? That's an excellent support level. So if Tesla drops into 250, I would say between 250 and 220, there's got to be someone. You'd think there's a buyer down there. Obviously place your own risk on these types of positions. Most traded zone on NVIDIA, incredibly important. We find more bids here. This is a very important zone. So we'll be watching that chart over the next 24 hours. And semiconductors starting to look worse here on the monthly chart. A lot of dojis. Are we heading down? I mean, you could show most people this chart and they will probably say that looks more negative than positive. I wouldn't disagree with them. You've got dojis everywhere. And then suddenly you've got this break low, which was from February. So are we heading lower? It's possible. Have to find that monthly kind of 20. That's going to be the key level to look at. Let's jump on over to Chinese stocks, which have dropped but still holding firm. So we'll just expect them to go sideways a little bit here. And obviously the US 2000. Let's have a look at the US 2K. The US 2K has dropped to a level that I would assume is buyers around here. So this is similar to hitting the daily 200 on the S&P. Somewhere around this price here of 2070, 2080 could be interesting. Absolutely no confirmation yet from the market in terms of structure, though. We'll have to update that. And the NASDAQ is right where you would expect buyers to be. And this red box here is kind of where, if the market is going to continue up, really needs to start holding. So not shocking stuff yet, but a lot of people will be screaming this thing is absolutely trashed. Well, we don't know that yet. We just have evidence that things are getting more and more late cycle by the day. Let's now have a look at Ethereum. Oh, wow. That is a huge pump and dump. You know, it doesn't matter whether you're looking at Solana, which actually had the better chart on it, ADA, XRP, they all pumped, they all dumped, and they all hit those daily 20s and got absolutely flogged. And these are huge moves. I mean, this is absolutely extreme stuff on the options market in crypto, actually in Bitcoin, which I think is the second largest trade now of all options markets. But in general, this Ethereum chart, again, just doesn't look good. I mean, we've talked about how it needs to regain the structure. It looked okay as of yesterday. Look at this Bitcoin market, full rally up. And I think what's interesting for Bitcoin buyers, because really, I mean, if you look at this Bitcoin reserve kind of discussion, the thing is, it has to be Bitcoin, yeah? It has to be. It's the one that makes the sense. I mean, I don't know what's going on with these other coins. Some of you guys are going to say, oh, no, I love XRP or something as being the Bitcoin reserve. But generally speaking, you've just got to think that it has to be Bitcoin is the one that you want to be going for that. And it has held much better, but it's getting down to the golden pocket, the 61-8 ratio. Around here is where you'd have to think markets will turn towards the upside if they're going to pay attention to this crypto reserve thing. So we've got information coming on that. We've got tariff stuff going on. That'll be a day by day. There's a lot of vol here. I always say come from the abundance mindset, guys. Patience, react, don't predict. If you're too scared of these markets, if you don't have commitment towards whatever you're doing, just don't trade. You got cash. You know, cash is fine. Cash is good in 2025. There's no problems with it. So remember, if the market's too terrifying, sit out until you find opportunities. If you're going to miss out on these big volatile swings, then obviously you cannot have FOMO. But remember, abundance mindset, always another opportunity, and it is certainly wild out there. Practice risk management whenever possible. I know it's boring, but it is pretty important. As we know, guys, the big news of the week is going to come back to these unemployment rates here. As you can see here, guys, the unemployment rates have been pretty consistent recently. It isn't expected to probably show all of these things that are happening right now in the economy, but with Fed Chair Powell speaking afterwards, I'd say that's where the big move is. And this is happening at 12:30 p.m. New York time. So that's going to be the one to watch, along with, of course, the upcoming discussions about tariffs and the crypto reserve, however that looks. Guys, if you are worried about the markets right now, just remember, abundance mindset, always come from things in a different, fresh look. And as we've been saying all year, it's a defensive style market. You know, some of the best sectors are outside of the US or even in the US in the defensive side. And that's just been kind of what's been consistent. If you're expecting sideways to a slow grind up, then you're probably not looking at the Mag 7 as being the best gains. Either way, we'll continue to follow the structure. Make sure to subscribe. We'll be tracking it. And of course, we'll figure out what's going on together. Let's see if these dark pools hold up with structure. This will be interesting.